Hey everyone, it's Tony Leonardi, your CFP professional from Newtown, Connecticut, back with a smarter way to retire, because there really is a smarter way to retire. Last week, we talked about why your IRA and 401k are the best place to save money while you're working and just about the worst place to retire or die with that money. Remember, RMDs, whether you need them or not, forcing you into higher tax brackets, higher Medicare premiums, and forcing your heirs, your kids, to liquidate your remaining IRA balance within 10 years, sometimes at an even higher tax rate than you, and the IRS just loves this. Today, we're hitting the second half of that 1-2 punch that catches most retirees completely off guard. It's the one risk that can wipe out decades of disciplined savings in just a few years, and almost no one talks about it the right way. Ready? Volatility is your best friend when you're accumulating wealth, and it can be your worst enemy the day you retire. By the end of this episode, you'll know exactly why and the simple shift that can make your money last 10, 15, even 20 years longer. So let's dive in with a client story. We'll call this the $1.8 million nightmare. I have clients, we'll call them Bob and Susan, age 67, retired a few years back with $1.8 million in a balanced portfolio. They did everything right. They saved, invested, at every crash while they were accumulating their wealth. They never panicked, and it paid off for them with $1.8 million in retirement assets. When it was time to retire, they did a back of the napkin retirement plan and figured, well, we'll just take out 4% a year, $72,000 on top of our Social Security, and we're set for life. Our money will never run out. The first 2 years of retirement, the market was going up and they were feeling great. Year 3, the 2022 bear market hits. Portfolio drops 22%. They still need their $72,000 for living expenses. In fact, they need a little bit more than that because of inflation. So now they need over $76,000 to cover their expenses. So instead of selling $72,000 out of a $1.8 million portfolio, they're now selling $76,000 out of a $1.4 million portfolio, because remember, the market was down in 2022. So that's no longer a 4% withdrawal rate, which is what they were counting on, but rather a 5.5% withdrawal rate. So Bob and Susan think, okay, we went from 4% withdrawal to about 5.5%. That shouldn't be a big deal. It's not a big increase. No big deal. Wrong. They had to sell 35% more shares than they planned to at the bottom in order to pay their bills. So to get back to their original $1.8 million trajectory, their portfolio now has to return not the 22% that they lost in order to break even. They need almost 44% from that low point now just to get back to where they would have been if the bear market had never happened. One bad sequence in the first 5 years can cut a 30-year retirement plan down to 18 or 20 years. And that's with the market eventually coming back, which it always has so far, fingers crossed. The problem is when you're retired, you don't have 30 years to wait for eventually. And that's the big problem. So the original plan with no bear market in the early years had them in year 3 with a $1.95 million portfolio taking out $76,000. Where they actually ended up after year 3, after that 2022 bear market 22% drop, they're taking $76,000 out of a $1.4 million portfolio. Again, they need a 44% return to get back to even. So fast forward 5 years, assuming that everything goes back to a pattern of normal ups and downs with the same withdrawal plan, their original $1.8 million is now projected to run out at age 82 instead of age 95. Same investments, same average return, just the wrong sequence. This is actually called sequence of returns risk. Have you heard of this before? It's the silent retirement killer most people never see coming. And with sequence of returns risk, your neighbor could get the exact same average annual return over time that you got and never run out of money. while you're broke in 18 years. Well, why does that happen? Well, because average annual return over time doesn't matter as much to a retiree's portfolio as the sequence of returns. Or more simply put, when do you get those good years and when do you get those bad years that surprise you? A few bad years early on in retirement could be devastating, while a few bad years late in retirement could be totally harmless in terms of not running out of money. So when those bad years happen is really critical. So why does volatility flip from a friend to a foe? Remember, when you're working and adding money out of every paycheck into your 401k, market volatility is actually your friend. Think of a market dropping 20%. You're going to buy 25% more shares for the same dollar investment, driving your average cost down over time. That's called dollar cost averaging, and you put it on steroids. Which is why I never understand when people say, well, I'm not adding to my 401k now because the market's down. I'll wait until the market gets better before I put any more money in. That's the exact opposite of what you should be doing. When the market's down, you ideally want to load up on more cheap shares that are on sale. Take advantage of those sale prices. Everyone loves a good sale, right? In terms of investing, market sales are way better than any sale you'll ever see at the mall. Trust me on that. But the day you retire and start withdrawing money, the game changes completely. The market drops 20%. You need to sell 25% more shares to get out the same dollar amount to pay your bills. And the result is your portfolio has fewer shares left to recover. You've now locked in those losses permanently. You can get caught up in what I call the snowball effect, where between market losses and your own withdrawals, you can't recover. One bad year early in retirement can cut your portfolio's lifespan by 8 to 12 years or more. Study after study, look at Vanguard, Morningstar, T. Rowe Price, Google sequence of returns risk. These studies show the same thing. The sequence of returns in the first 5 to 10 years of retirement matters more than your average return over 30 years. Let me repeat that. The sequence of returns, when you get good years and bad years in the first 5 to 10 years of retirement, matters more than your average return over 30 years. The simple fix, you need to build some retirement income guardrails into your plan. And here are the exact moves we make with clients the year before and the year after they retire. First, we want to build in 12 to 36 months worth of cash or ultra safe investments in a safe bucket. That bucket covers your living expenses in the first couple of years, so you never have to sell stocks or bonds when the market's down. Think high yield savings, short-term treasuries, or a conservative fixed annuity. You can create a flexible spending rule. So when you have good market years, you can take out a little bit more. Bad market years, you can cut your discretionary spending a little bit. One couple I work with calls it their eat out less rule or the travel less rule. And that saved their plan in 2022. You can use a dynamic withdrawal strategy, and we model this for our clients. If your portfolio drops below a certain level, reduce withdrawals if you can. If it grows above a certain level, you can increase withdrawals or take a bonus vacation. You can shift your allocation gradually. Retirement investing is not a set it and forget it, a 60-40 model. More bonds and dividend-focused stocks early in retirement to offset those potential early bad years. And then you can add risk slowly as your cash bucket refills. You can also consider a small income annuity for the must-have expenses. That turns part of your portfolio into a personal pension that markets can't touch. Another way to look at retirement income is fixed income to cover your fixed expenses, your needs, variable or market-based income to cover your variable expenses, your wants and wishes. So a real result for that same $1.8 million portfolio, same 6% average return over time, the old plan had a 22% chance of running out of money by age 92. The new plan with guardrails, only a 4% chance of running out of money. That's the power of managing sequence risk instead of hoping for good luck. That's also the power of modeling. I have several clients that still like to manage their own investments, and they tend to manage their investments just like they did when they were accumulating. Modeling shows that they, in many cases, are taking on too much volatility in their retirement and reducing their probability of success. What's the old saying? It's hard to teach an old dog new tricks, and that certainly applies here. So here are your action steps. If you're within 5 years of retirement or already recently retired, ask yourself 2 questions. Do I have enough safe money to ride out a potential 3-year bear market without selling investments? Do I have a written plan for what happens if the market drops 30% next year? If the answer is no to either question or I'm not sure, let's fix that. You can take my free 2-minute retirement readiness quiz. It will show you exactly where you stand on sequence risk and a dozen other factors. You'll also get your score instantly, and you'll get a copy of my book, A Smarter Way to Retire, at no cost to you. You can find that on my website at leonardifamilywealthcare.com/quiz, or you can just book a complimentary 15-minute call, and I'll run your personal sequence of returns projections and your probability of success numbers with your real numbers. You can find my calendar at leonardifamilywealthcare.com. Look for the contact and Calendly tabs. So that's sequence of return risk. Thanks for listening. Don't forget to plan smarter and retire happier, because there is a smarter way to retire. We'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.